Hello friends. Today we'll discuss one of the most important recent regulatory development by UP RERA relating to maintenance and operation of the project bank account. These directions are issued on 11th May 2026. This is the third revision superseding the earlier directions issued in the year 2023 and 2020. These revised directions strictly tighten the financial monitoring and compliance framework for the real estate projects in UP. Let us briefly understand the key changes and their practical impact on the promoters, RERA compliance professionals, banks, and other stakeholders. So, first is maintaining mandatory three separate accounts for each project. This provision was already existing. Each project must have three separate accounts: 100% account, 70% account, and 30% account for each RERA registered project. Further, these accounts are required to be maintained in the same district in which the project is situated. Now, these accounts cannot be maintained in any other district or NCR where the head office or the corporate office of the promoter is situated. If all these three accounts should be clearly shown on the UP RERA web portal. If these accounts are not shown on the UP RERA web portal, then the promoters are advised to file Form RA2 and the bank statement and display all these three accounts on their web page. The next is the automatic transfer of the collection from 100% account to 70% and 30% accounts. The promoters are required to issue standing instructions to the bank to transfer the entire collection to 70% account and 30% account. 70% account can be used only for the project related expenses and 30% account is a free account. All the customer receipts are mandatorily required to be deposited in the collection account. Similarly, all the project finance issued released in favor of the home buyers are also required to be deposited in the collection. There are stricter provisions with respect to the project finance. The project finance and NCDs, debentures, etc., are required to be deposited in the designated project account as prescribed under these directions. And these are also required to be reported to RERA under in Form RA8. Further, the loan against the same project, the project loans can be availed only against the same registered project and it cannot be cross-utilized for other projects or other entities. Mandatory project-wise costs should be apportioned if there are more than one projects or for which the funding has been taken. The collection account and the separate account, both these accounts should be no-lien account and banks cannot debit any of the charges, etc., any encumbrances from these two accounts. The next provision is with respect to the repayment of the principal and interest. This is a long outstanding demand of the developers that while the project finance is required to be deposited in the RERA designated account, its repayment for the principal was not permitted from the 70% account. Now UP RERA is permitted that if any repayment for the project principal or interest or the project finance is there, it can be withdrawn from the 70% account. Similarly, payment for GST, 70% payment of the GST is also permitted from the 70% account. Refund to the allottees is also permitted to the extent of 70% from the transaction account. However, there is a restriction on the penalty or compensation payment. It is made expressly clear that any penalty, compensation, fine, or interest liability cannot be paid out of the project funds collected from the allottees. It means it can be paid only from the 30%. Next important provision is with respect to the restrictions on assured return and incentives. The restriction on assured returns and incentive was already there. It has been made more strict now. Any assured return scheme, incentives, guarantee, returns, similar financial commitment are restricted and cannot be funded from the project specific protected account. Mandatory use of collection account should be there for all loan disbursement and it should become only in the collection account. The funds can be withdrawn only upon certification from chartered accountant, architect, and engineer. These three professionals are required to give the certificate, and based on the project completion, the funds can be withdrawn. In the CA certificate, use of the mention of the UDIN is mandatory as usual. Now, RERA is likely to make a system for online generation of architect, engineer, and CA certificate. It appears that the web-based forms and the compliance system referred to in earlier circular is likely to be operational very shortly. The chartered accountant issuing the quarterly certificate, should be different from the statutory auditors. The statutory auditor at the end of the financial year within 6 months is required to give a report in Form REG 5, and while reporting, he has to report if there is any false or incorrect statement was issued by the architect, engineer, or chartered accountant, or if any project funds were diverted or misutilized, or any withdrawals were not in proportion to the project completion. And if he reports like any of such thing, then UP-RERA may initiate penal action under the Act, refer the matter to the respective professional regulatory bodies of the concerned architect, engineer, or chartered accountant, and such action may include dismemberment or other professional penal consequences. This provision significantly increases professional accountability of the certifying professionals involved in RERA compliances and fund withdrawal certification. An important provision has been made now about the validity period for the withdrawal certificate. Now, the withdrawal certificate issued in a particular quarter are valid only till the end of the immediately succeeding quarter and not thereafter. RERA has also permitted flexi deposit scheme from the 70% account if the banks allow that the funds can be deposited into the fixed deposit. They are permitted to avail the benefit of flexi deposit or fixed deposit or earning interest, but the the repayment must come in the same account. An important change has been made for the change of the bank. The change of these bank merely on account of the availing the project finance from a bank is now prohibited, is not permitted. A strict provision is made for the condition for the closure of the bank account. After receipt of the completion certificate and after repayment of all the dues, the promoters were allowed to close the bank account after taking approval from UP-RERA. But now one important condition has been introduced, that before closure of the bank account, transfer of the common areas to the association of allottees has been made mandatory. It will have a major impact because the formation of the association of allottees in UP require minimum 60% occupancy. After formation of the allottees, then the assets are required to be transferred, and after transfer of the common assets, only the bank accounts can be closed. At the same time, RERA has issued directions that after the lapse of the project completion date, banks should freeze their bank account. Therefore, the funds of the promoters are likely to be stuck up in the bank account till the association of allottees is formed and the common area is transferred to them. RERA has also issued directions to the bank for freezing the operations after the expiry or after the lapse of the RERA registration. RERA has also issued extensive directions to the bank to verify the project registration, monitoring the project withdrawal, compliance with the account structure, reporting obligation, freezing of the accounts, restriction on unauthorized transfer, and ensuring adherence to the RERA directions. A detailed framework has been introduced for the land cost determination also. In the case of development agreement, there was a confusion how much land cost can be included towards the cost of the project. Now it is made clear that the land cost of the landowner or applicable circle rate, whichever is higher on the date of registration of the RERA project, will be deemed as the land cost. In the case of gifted or inherited properties, only the circle rate prevailing on the date of registration, RERA registration, will be applicable. All the payment towards the development charges, FAR charges, interest payable to the banks, financial institutions, etc. are allowed. However, if the interest is paid to NBFC or any unsecured creditor, it will be capped to the State Bank of India MCLR. Any type of delay payment interest or any penalty will not be included in the land cost. Let us understand what is the overall impact of these revised directions. The overall impact on the revised directions will substantially tighten the financial discipline and monitoring of the real estate projects by preventing diversion of the project funds, increasing accountability of the promoters, banks, certifying professionals, and withdrawal system. It will restrict use of the protective funds, and it will strengthen and protect the home buyers' interest. Stakeholders may therefore review their existing RERA bank account operations, CA certificate, treatment of project finance reporting, and take immediate steps for the future course of action. I hope you will find this discussion useful. Please note that this video contains only a very brief overview and summary of the revised directions. Stakeholders are requested to carefully refer to the complete circular and detailed provisions for proper understanding and compliance. If you have any queries or questions, please feel free to reach out. Thank you very much for watching all this.